the net account value is now 78,300. That's we have had.
No, no. No, I'll do this as well.
Hang on, we've got a very young member apparently.
Oh yeah.
Thank you. So we got 78 up there and 54.5 down here. What does that tell us, anybody?
You can still buy some more stuff.
It means that's right. We have some buying power. Account value healthy at 78,000 plus, and stock buying power, we like to keep that as at least half of the value of the net liquid value. And so we've got a good 14,000 or something that we're okay with. Some of that we might need to do some maintenance on existing stuff, but I have got some trades available should we care to do them. We may well not do them during the course of the meeting because it takes too long, but we'll give that a try if it comes up. But what I want to do is to go straight to the spreadsheet. Okay, so there's a lot of, we're looking at a lot of numbers here. A lot of work goes into this, I can tell you. So what I'm interested in first is the top half of this screen. Is it large enough? Can you actually see it?
Yes, Jeff, it's fine.
Good. So these are the stocks that we currently own, okay? So we've got quite a few stocks, probably a few more than we actually want. Then you can see the price that we've paid for them and the current price. And that current price should be somewhere near. If I go to data and refresh it, it might update a bit. It is, because it is linked to the prices from the stock market. So if they're not quite right, they wouldn't be far off. Then we've got the number of shares, and then we've got the position that we're in on them, which isn't always brilliant. If it was brilliant, I would probably have got rid of them already. I'll just do that so we can see which ones are in red. Meet somebody else. There we go. Yeah, so the ones that are in healthy profit, I normally sell calls on and get rid of. So that's a straightforward. We paid 11. It's near enough 9 at the moment. And so we've got 300 of them. But then we get put income and call income and get to a net exposure. So we're actually only $1.83 on that underwater. And we've got, if you then multiply that by the 300 shares that we've got, you find out where we're at. So overall, we're about $750 on those stocks to the bad. Not worried about that in the slightest. Still people coming in. The figures here under this column are the amount of put income we would need in order to put ourselves straight. And they are all pretty low. In fact, there's only one there. There's $2.72 and $2.60. The rest tend to be much smaller than that. In the next column, we've got the forecast of where we expect these prices to get to. And then we've got what value line think is going to happen to the stocks. First of all, in the next 18 months, and then in the next 3 to 5 years. So what we need to do is to say, well, okay, then. So we've got these. Generally, we can sell calls against them. We can get rid of them anytime we want for a profit. But are they likely to come to better prices? And are we therefore better hanging on to them for the longer term? So in this column, I've said, okay, compared to the forecast, so in this case, 11.50, what have we paid? And we paid $13. So we are, even if it gets to where we expected to get to on the forecast, we are $1.50 behind. So that's not one we want to keep, we want to get. When it gets to forecast, we would be 70 cents underwater still, and it would be $210. So that is a candidate, and I've ranked them from worst to best sort of thing, on although I don't see how that's from lowest to highest. It is actually. So the top ones are the ones we want to probably move on.
Jeff, can I ask a quick question?
You can.
What time frame is your forecast in? Because you've got the value line forecast at 18 months for $26, and obviously yours is less than half of that at 11.50. So what
Yeah,
time
ours
frame-
is a short term. We're looking at sort of 4 months ish.
Okay.
Yeah, so we're looking at the shorter term. We're looking at the sort of period that we would be selling an option for, and that's normally 3 months.
Okay.
So yeah, we don't want to wait particularly 18 months.
Jeff, how do you get your forecast then?
I get my forecast by listening to the webinar on a Sunday evening, where Owen goes through every single stock and does an analysis and reaches an opinion on a forecast. I go through that ahead of him and put my own figures down and then compare what I think and what he thinks. And if there's any significant differences, then I speak to him and try and find out why we have a different opinion. But and that's how I do it. Anyone that's done the MMCP or has attended the training, for example, that we did back in September in Derby, is entitled to attend those webinars and to see those forecasts in action, which I want everyone to do. But I actually do record them, so you'll be able to get them. So if I go to...
Are yours and Owen's forecasts more based on technical analysis of the charts rather
definitely purely on, yes, purely on. Can you see I've changed screens here?
Yep.
Let me just see if that'll refresh as well while we're here. So what we've got on here is a link to Google Finance. So the stuff in green over to the left, these are 15-minute delayed prices, and we've got prices, we've got price to earnings ratio, earnings per share, the low and the high, and the low and the high over the last 12 months. I then have recorded the forecasts that we've come up with between us on Sunday night. That's that column in the middle there. As well as producing that forecast, what we also get from it is a watch list, and that is stocks that are forecast to increase and for which the indicators are looking good. So I record that separately. Ignore those dates. So in the case of AEO, for example, American Eagle Outfitters, it's been forecast to increase, and all I've done is put that into a separate column so I can copy and paste these ones that are, we think are worth a punt. There's a lot of work to take place after that, though. So I'm going to change screens again and briefly show you what I do. You see, you've asked me a question. You get an answer now. First of all, for each of the clubs, I'm recording what we're currently in, Tees Fortune. So these are the stocks, expiration months, if there's shares, I put shares in, and the number of contracts, so they're all 100. So I'm keeping that up to date. I'm cutting and pasting those the actual prices into here. So these are current prices, and that's the forecast list that Owen's done on a Sunday evening. And then the ones that have good technicals on them as well, they're actually, I've indicated that by putting them in this column here. It looks as if they all are. That's just because I've changed the order of it. Once you get below there, they're basically not. And I've excluded others for other reasons. Whoops, where's that gone? That's actually, so it's actually the end of the analysis, the list here. So I've got here a watch list of stocks that we expect to increase. And I've got in column AH there, the percentage that we expect them to increase by. And that's ranging from 85%, down to sort of tiny, if you like. And then looking at each of the clubs, he's Tees. I'm saying, okay, then, so T's, they have got ideally 1.1 contracts of, it's actually AEIS, that one. And we've actually got 2 contracts, so we're a little bit overboard on that one. So that's telling me whether there's scope to expose ourselves any more to those that have been deemed to be worth going after. I've then got a column which puts in the, and I've called it the SI score. It's really the TICN score. These are the 4x4 scores. So Fossil has been rated as 52, for example, others 97, all sorts of things. That's where there's an official 4x4 score. I put it in there. Current price, again, that's just so I don't have to keep going back over the page and forecast and the increase. And then a value line. So I'm constantly I update these every week. So at the moment, the last ones that I changed at the weekend were forecasted. I took out forecasts that had been done as recently as the 22nd of October and replaced those with ones that were done on the 21st of January. Next week, I'll be taking out the 29th of October and replacing it again. I've then got my opinion, just a visual opinion on the risk to reward ratio, whether it's medium, low or high. I'm not interested in ones with a high risk to reward ratio. I've then looked at just the difference between where the price is now and the forecast to say, well, if I was going to go in there, what sort of strike price would I want to go at? And I've also then looked at the slope of the charts and say, well, okay, how fast or slow is it moving? How much time do I need to give this stock to get to the strike price area that we're looking at? I've then looked at right in the bowels of the thing to say, well, okay, if I did go for that trade, for example, the 22 strike price on beds, bathroom and beyond, what would the lid strike price be? And in this case, it's good. It's only $1 below. In lots of cases, there's one where it's $2.50 below. There's plenty where it's $5 below, which I don't tend to like those ones. How much would we want to pay? Get paid for selling the option. So that's just taken from the price that is currently shown when I do the analysis in the trading platform. How much of that would we be giving back as a lid buying amount if the lid triggers? So what would we be left with as a net? Sometimes I'll look at the stock buying power, but not always. It's because it's a huge amount of work. And then I'm saying, right, if this isn't put to us, what percentage would we make? So that is the premium as a percentage of the strike price. So we're not actually paying the money out, but I've got to find a way of ranking these trades. And I've ranked them, and there they are. They go in order from 25% down to 10.65. If I do put the amount of stock buying power in, I can then work out, well, okay, what is it if we have the stock put to us? And there's not normally much of a difference. I haven't done it. I also look at, well, if we don't allow the lid to trigger, if I close the trade when there's 85% of profit present, how much of a percentage would we get then? And that's in there, and you can see that they're not that different. So I tend to be a bit trigger happy and to say, I don't really need the thing to get to expiration. If there's a decent profit there, we'll have it, or if there's another good reason, we'll do it. So by the time we get to recommending trades, we've been through our forecast, the forecast of value line. We've looked at the risk to reward ratio. We've looked at what strike price we're likely to go at, what the lid strike price is likely to be, how much the lid will cost us, how much we expect to get for it, and how much we expect to make if we actually do the trade. So there's a huge amount of work. The next one, which is boxed here, from that, I'm looking at, well, okay, if we have 5% of our net liquid value in any one stock, what would it mean in terms of how many contracts are we likely then to be able to sell? So in bed, and they are rounded, so in bed, bathroom and beyond, we're at -1. So we've got probably, it won't be a full contract, it'll be part of a contract's worth of too many, if you like. We don't like that figure to get too high, but I don't mind 1. The next one, we don't have any scope. The next one, which is fossil, we've got scope for 1 more contract on it, so that if we sold 100 puts on 100 shares of fossil at a strike price of fossil, third one down, $15 strike price for the month of March, then that would, and it got put to us, that would mean we had 5% of our value, current value, in that stock. So there's scope for 3 on CDE, BB, Ollie 1, Cake 1, ATGE, PETS, and so on. So for each of the accounts I look after, I end up with a potential trade list. Wow, that was a long answer. Is that what you want to know? Yeah, any questions on that? That's a lot of stuff there.
It was a really good answer, Jeff. Thank you.
Yeah.
Very informative.
Yeah. It takes a long time to do all that. That's why I don't like people ringing me on a Monday morning. That's what I'm doing. Okay, so that's where the forecast comes from. And that's how we came to sell puts that ended up with us owning these stocks. And here are the puts we're going to come to that we've sold for January. Now, we've done it before, and I'm happy to do it again to show that we don't have to worry about any of these, because if we want to get out of them, we can just get out of them. If you want to choose one at random, we will. Do you want to? Let's have a look. What should we get out of? What don't we like the look of? Let's choose one. Well, what we should do is say, well, the worst case is this one here. So that's only a cheaper. I don't want to do that one. CD, that's a cheaper as well. They're not worth doing. They're all quite low cost, those shares. Let's have they're -6. Here we go. Good old fossil. So here we are talking about selling a put on fossil at 15, but previously we've actually sold a put at 22 and had them put to us. So let's see if we can sort that one out. So what have we got? We've got 200 of them. So let's go through the calculation, and I'll show you. Does someone want to write these figures down? I'll write them down just in case. So fossil, we've got 200, and if we go over to the right here, you can see the current price of fossil. There it is, 1071. So the first figure I'm going to put in is -22. That's what we paid for fossil. And it doesn't show on there, but that's what we paid for it. So that's money gone out. If we sell it now, we'll get $10.71. Okay. I'll just check back to my other screen for a moment. What we also know is when we did sell that fossil put, we got $9.63 for it. So that's plus $9.63. We haven't sold any calls on it, so we can now do that calculation, which is -22 plus 10.71 plus 9.63, 166 minus 166. So on this trade, we are minus 166 down. So now we go to the, and we got, let's just check here, it was 200. And if we now go to the option chain And I put in there the ticker FSOL.
FOSL.
Oh, sorry, FOSL. Same company, different ticker. Fossil. You know, everyone knows that they're the watch company. And we're looking at March. You can see the current price there, 1071. And we are 166 down. So we need to bring in income of at least 166 to be in the pink. All right. And we sold these shares for 1071, having paid 22 for them. So we could go, these are the bid prices, these are what we'd get. So we could sell a 16 or a 15 perhaps now, and we'd get around $4.40. We might get a bit more, to be a bit of negotiation. So that would then add to the calculation plus 4.4, which would mean we were now $2.74 in the black. And instead of effectively paying $22, we would have made a promise to buy them for $15. That's a much lower target for us to actually try and hit. I'm going to stop sharing yet again and show you something else, which is, can you see that? We're now looking at the
Yes.
the chart. So first of all, I'm going to look at fossil. There it is. Okay, so it is at a good low, no doubt about that. It has been lower, but it's trended down here. And we're saying we need is to get to here. In fact, we'd like it to get above 15. If it gets above 15, we just keep the money and don't have to buy the shares. And it's been there lots and lots of times. 22, which is where it was forecast before, was on the basis of this thing. So I presume. Anyway, so there we go. And we can see the indicators. They've turned around, they've done a V on the stochastics, and the MACD and the RSI, they've both been down and are on their way back up as well. So that looks a reasonable trade to do. Any questions?
No, seems a good one.
It's magic, though, isn't it, really? They can do what they like, it doesn't worry us.
If the
So what do we think? Do we think the 15, the 4, I mean, we could actually, for 166, we could actually go down to the $12, which it'll do well above that. However, there is value in that.
I would say the 15 because fossil's on the rise now with all the trouble with gas and everything.
Oh, it's nothing to do with gas and that, Pat. It's watches.
I'm in the wrong trade here.
However, let's just say they got put to us at 15. So it'd be 15 minus 440. So we'd be exposed to $10.60 plus the $1.66 that we were underwater before. Our exposure on this stock would be $12.26. So 15 is not a big risk for us. Let's see if we can get some. And we had scope to buy another one anyway, so we can add something in. Right, so that is March 15, 440 by, so that the two prices, we are selling, whenever we're selling, they want to give us the lower price. If we're buying, we pay the higher price, but we can do a bit of negotiation in between. And we want to, well, we'll sell you the, well, sell you in a minute. I should normally have done that first. So we go for 3 and we will try for, let's try for 450, just to be cheeky.
Yeah, why would we go for 3? I thought we had 200 shares.
We did have 200 shares, but we also on the analysis that we've done for this week, we found there was also scope to
for the extra one. Yeah, sorry. Got you.
And also, is that David, is it?
That's Andrew.
Oh, sorry, Andrew. The other thing is that when that forecast for getting 5% was based on a higher strike price than, sorry, it was based on 15, but the others we'd paid 22 for. So this is, we can easily do 3 and stay within 5%.
Right, okay.
Right. Why do
So-
you pick 450 instead of 455, Jeff, which is a split the difference between the bid and the ask?
Well, you usually get about a third of it. And also, I suspect, and I might be wrong, that this will require 10-cent changes.
Oh, right,
Well, I'll
okay.
put 455 in and we'll find out. So I click on verify, and yeah, it's saying
Oh, okay.
price must be divisible by 10 cents. So that's no good. What we can also see while we're here is that the total cost is likely to be just under $2,000. We have to double that to get an estimate of how much stock buying power it will use. But when we sell the stock, we'll also be releasing our stock buying power, so we're not going to worry about that. So we'll change it back to, well, we'll go for the 60. Just I don't think we'll get it, but I almost don't. Oh, look, yeah, the live price is 70 anyway. We might get it, but I don't actually like to get it on my first attempt. I feel as if I've sort of undershot, and we haven't. So the next thing we do is go to our orders, and we're filled. So we actually got the 460. So what I want to do now, we need to sell the fossil stock that we've already got. So just back to the portfolio, click on it. Let's see. So there's only 2 cents difference. But we might as well try and get one of them. So 1069. So we'll 200. Yeah, check all that. And this time, because this trade allows movement by 1 cent at a time, we can actually use these little up and down arrows. So what are we doing? We're selling. So if we're selling, we're going to be going down until we get to a price they'll accept. There we are. So it's gone through all of them at 1066. Now there's something else we need to do. Anyone got any ideas? We need to put a lid. Exactly, yeah. So here we go. So I'm going back to the portfolio. I found there's fossil is now at 0. And the cash has gone up. And I simply click on this. What else do we do? So it's 3, it's March. There's all sorts going on here. And I go 1 strike price down, which is to 14, and give them 10%. What do we get? 10%? Where is it? There it is. We got 460. So I'm going to, now on this, when we set the price on here, normally the 5 cents are fine. So I'm going to offer them 45 cents. So this will only trigger if the promise to be, if we can buy the promise for someone to buy these from us at $14, if that comes down to 45 cents, then we'll have it. That will give us some protection and release buying power. I think I know what's happened. What's happened is, yeah, I know what's happened. We've already got in there the old order. So I need to go to fossil. So we've got the old lid order in. I don't know why.
Screen refresh, Jeff.
Pardon?
Is it just a screen refresh required, maybe?
So instead of going into the old trade, we'll do it from scratch, which is, so we want trading, fossil. We want to buy to open 3 March, strike price 1 down from what we went before, which is 14, and it's a put, and we want to give them 45 cents. Martin, I'm disappointed. You didn't say, yeah, if you haven't put the lid thing in. There. See if that goes through. There we are, done. So that's that trade complete. So we go back over there. you won't see that one there because it's a limit order. So, that's now that. So that is how I'm going to stop sharing yet again. Go back to the chart, the Excel. So I'm not going to knock this off here because what I'll do is I'll make some notes at the end as to exactly what we've done, so that I can keep an eye on it using all of the figures involved. So that was the worst one. It was $6 adrift, if you like. The rest are no problem. Now, another reason why I was happy to do that tonight is because we get the best prices on options when the volatility is higher. And we see the volatility measured by something called the VIX. So this is inverse to the market. And if I keep down there, so basically the higher this is, the better the prices we get when we're selling puts or calls. And the lower it is, the less volatile it is, the less we get. So this is quite a long period of time. I wanted to show you that generally every month, most months, we get a bit of a spike. This one was actually back in December when everyone around the world was getting excited about the new strain of the virus, and oh my goodness, the roof's going to fall in yet again. So share prices came down, volatility went up, and option income went up. And so we might get a bit more of a spike than this, but we're in expiration week. So if we're going to get a spike, it'll be this week. So I'll be watching it to see if it goes up any further to take advantage of it in the trades that we do.
Take it that's the market volatility, Jeff, not just the stock, the actual instrument.
Oh, absolutely. Sorry. Yes, this is the market. Not it's no one stock. This is all of it basically, and it's the options market. So it's the CBOE, if you can see it at the top there, which is a Chicago Board of Options Exchange. So these are all the options that go through, all the trades that go through the options market in Chicago. And it has the indicators just like a normal stock, and that says, yeah, it's about to rise. So we'll be watching that on a daily, if not hourly basis, and away we go. So that's what's happening with the stocks that we currently own. We're simply waiting. Oh, yes. We're just waiting for the right time, either for them to move towards the forecast, which we're happy for it to do. And if the forecast isn't high enough, then we're looking for the right time to do something about it. What I've also got here, columns Z and AA, these are the percentages shown here are the percentage at the current price that the stock makes up of our portfolio. And I actually changed that this morning. It's gone up to 78 from 70 this morning, so that needs updating. So if I put roughly 78,000 in there, it was about that. Those percentages will change. And the next column is the percentage that the stock would represent if it gets to its forecast level. So some we've got only like 1 or 2%, so there's scope to top them up. Others, where if it gets up to forecast, we'll have like 10 or 11%. So we'll be wanting to get rid of at least some of those. So that's where we are with existing stocks. The next lot is, these are puts that are due to expire on Friday of this week. So what have we got? We've got the ticker symbols, we've got the strike price that we'll be paying if the stock is put to us, we've got the current prices, the number of contracts, and the premium that we got for selling the put. There are no lids involved because we don't own the shares yet. And no net premium because the premium is the net premium. There's no call income to worry about. So then we've got our exposure. So that's simply the strike price minus the premium that we got. And then we have a bit of exposure here. So we're 3 cents underwater on BlackBerry. And because we've got 200 and that multiplies up to $6. So we're not going to get too worried about $6. And I did it deliberately anyway. We'll come back to BlackBerry. These prices are falling because we're moving towards expiration. There are none here. I mean, the worst case is $478. And that's Newmont Mining, the biggest mining company in the world. We have a strike price of 70. The current price is 61, but we got $13.55 in premium. So we're exposed at $56. Not the worst case, it's a good case. So we're exposed at $56.45, which is $4.78 underneath the current price. So we're not going to worry about that one. So that's not a problem. What's the next one? The next one is Sage. And Sage is forecast to get to $80. So I'm quite happy to get into this. We've gone for the strike price of 60. The current price is 41. We got $16.60 in premium, which wasn't bad at all. So we're exposed at 43. We're only $2 away from the current price, and it's forecast to go to 80. So we could soon get out of that if we wanted to. Here's another one, Vayak. This one's more of an issue, I would say. Vayak, we are in for buying these at 50. Currently, they're only 35. We got $11, so our exposure is 38. So we, $3.77 away. However, it's forecast by us to get to $47, and we're actually on this one in the short term higher than value line. These are the value line forecasts. So nothing in here to worry about for the minute. So there we go. Any questions? And so, I have got some trades. Fossil we've already done. That was the most profitable trade that I'd profitable trade that I picked out for the evening. Others that we've got are CDE. We already have 300 of those. So there is scope to top that up. BlackBerry is a bit of a special case. We'll come back to BlackBerry. We have already got a January put of $15. We've just seen that, but there's scope for at least another one for April. Ollie, which is a big discount store. We've got some scope for that one. And Cake. If I was sexist, I would say, especially for the ladies, it's the American Cheesecake Company. So we've got some of those, but I just want to watch the volatility and see if it gets any higher before we actually sell them. But let me just show you one more thing before we begin to wrap up. I want to go back to the charts, talk about BlackBerry. So BlackBerry is a good old faithful. That was a spike when there was some shenanigans in the market last year. For quite a while now, it's just basically lived between sort of $9 and $12. It's a good old faithful. And it pays really high premiums when we sell calls and so on. So this is a really forgiving stock. You get good premiums for getting into it. We'll have a look and see what they are. And you also get great premiums for the calls. So
why is that, Jeff? Why does the market value it?
Because it's volatile. And by that, I mean, because the price moves up and down a lot. It's just
but only within that range, you're saying.
Yeah.
So it just bounces 9. I think you say 9 to 12, but it moves.
Yeah. So if we were, if we, in fact, let's just check back there. Yeah, if we actually, we don't own any of these at the moment. We will shortly, but we don't yet. But look at that. So we sold a $15 put to buy so a promise to buy 300 shares in January. So that's by this Friday. The current price is only $9.15, but we got $5.84 for making that promise. Well, yeah, that's like, so that puts our exposure nearer to $9 than 10. So when we get them,
That 15 price was way above the range that you said that it tends to trade in. So did you?
yeah, I think it was done when we had that period of very high prices and volatility. So we placed the trade 3 months ago. As it turns out, it was not a good forecast. However, we're never too worried about this one. So if we pick these up on Friday, we would then say, okay, let's have a look at selling a put to get some more income on them, please. And that would be, sell a call. We tend to sell calls 1 month out. So we're looking, they're not very high yet. I'm sorry, they're 41, 21, 30. They're not as high as usual. We definitely want the volatility up a bit. No, won't be selling those at those, but that will rise. As the volatility goes up, that will rise sharply, and then it'll be the time to do it. So it's definitely not the time yet. But again, we will either watch it or we will place a limit order to do it for us. So in other words, we'll decide the strike price and we'll decide how much we want to accept for it. And it would probably be, I don't know, say 6%. So we want 6% back off them. To work out what 6% is and put an order in that says, if at any time you're prepared to give us 6% of the price of these that we bought, then please go ahead and do the deal. If you don't give us 6%, don't do the deal. And then we'll just leave it sit there, or we can watch it. And there we have it.
I'm wondering about the forecasts, Jeff. How often, I mean, we rely a lot on the forecasts when we're selling put options. And how often do we actually hit the forecasts and are correct with them?
Sorry, I'm not quite. Are you asking how often is the forecast correct?
Yes.
I don't know. What you have, and I have sort of thought, well, I could keep a record of what the forecast is every week and go back over it. That's why there's extra dates on there. But I tend to think, well, it's a forecast made 3 months ago. There's nothing I can do now to change it. We're not going to get better forecasts, I mean, than we get from Value Line, even if you thought ours weren't so brilliant. But the other thing, of course, is that when we get a forecast, so let's just have a little look again. I'll just check the forecast on fossil is currently the forecast on fossil. Where's it going? Fossil.
So Jeff, I'll just jump in there if that's okay. So Martin, we every year, well, obviously not the last 2 years because of COVID, but we've visited Value Line most years in the last 15 years, and we asked them that very question because they've been making predictions for 91 years. They've started out in business in 1931, so they've been in the business of making projections. I mean, I can show you a historical report back in 1956 about General Motors. So to answer your question, their accuracy improves with time, but it's currently around about 85-90%. So 85% to 90% of the time, what they say is going to happen in the next 3 to 5 years actually does happen, and many times is exceeded because they tend to be conservative in nature. And also, if they believe a share is going to fall, they'll tell you that as well. So if Jeff wants to show you, say, for example, Tesla, their predictions are actually going to fall. So they're not always optimistically saying shares are going to rise. They're also telling us when they believe shares are going to fall as well.
Yeah, I think the other point that I want to make though is let's have a look at something here. So on this, this is AEIS, and we may well say, yeah, okay, there's a gap here to be closed. So we're looking at a forecast of sort of 100-ish. Or we're saying, well, and in the longer term, might get to 115, and even the longer term, back up to 122. We're then saying, okay, that's fine. We know where that forecast is, but then we don't say, oh yeah, right, we'll go right up here. We go wherever we can get a decent price, as close to the current price as possible. So even as a rule of thumb, we only go halfway between where the forecast is now, sorry, where the price is now and where the forecast is. So that's EIS is not on the list this week because of that. Yeah, if it's only going to be going up to 100 and it's already at 90, then we're saying, well, no, we're probably not interested in that. So we've got highly accurate forecasts from Value Line. We've got 20 years of experience of Owen and his team doing forecasts, and then we're only half believing them. That's where we're at.
And then if we look at the Value Line report for AEIS, they're saying worst case scenario 120, best case scenario 180. So that's over the next 3 to 5 years, and even in the next 18 months, midpoint range of 120. So
yeah,
that's way above the graphs that Jeff was even showing you there. So Jeff is only saying, you know, at best 120. They're saying maybe even 180.
Yeah, and I mean, we're interested in really the short term, selling a put over the next three or 4 months. If, however, it gets put to us and the thing's gone down, then we know that we still bought a stock which is good value compared to the forecast that is likely to get up to in due course. So yes, we're not being left hung out to dry.
Yeah. So on this graph here, Martin.
Oh, sorry.
Sorry. Yeah. Just to even look at that graph, Martin. See, we're at 90, and we can see 110 is very doable. It's been there twice already this year, 3 times. So you would just say, well, we're only looking for halfway, so maybe 100 we'd be doing at that stage. So
yeah.
So you're never pushing it too far in terms of where you think you can get to.
Yeah. Yes. And then I would be looking at, well, you know, on here we can see the risk to reward ratio. It's already fairly near its bottom. We'd be looking at where it is compared to its annual high, its annual low. We're looking, and we're also looking at the lid. So if we sold 100, the lid might be at 95. So if that triggers and goes in, and even if it saves us, it's going to cost us $5 on. So we want a premium that's going to give us good headroom if we have to pay that $5 out. So I'm filtering it's not just the forecast. There's lots of other factors to take into account, but it starts with the forecast. If it hasn't got a good forecast, then we're not playing with it at all.
Excellent. Thank you.
Great question.
So Jeff, just can't try and understand that a bit further. You don't know, or you don't care directly what's driven that uptick historically. So what factors made it go to 110? What you know is the market will value it at,
not quite true. Not quite true. That's where Value Line comes into it.
Yeah, I was going to say you don't, but Value Line have.
Yeah,
Value Line have some idea that's going to happen.
Value Line, you know, as well as looking at the profitability over many years there are, and the growth in sales and all of that, they're also looking at other factors. So they're looking at you know, what's happened in their market. Even if, for example, there was a lawsuit pending, what's going on with that? They're looking at how good the management team are at forecasting what's going on. They're looking at how the company has dealt with any issues in the past, and they're giving a commentary on what's going on with the company and the sector and the industry, which they're updating every. Okay.
Even behind the scenes, Jeff, they update their raw data every once a week. So they when the market closes on a Wednesday, they spend from all day Thursday and half day Friday producing a massive spreadsheet. It's, if you actually look at the spreadsheet, it's 6,000 rows deep for the 6,000 companies, and it's about 500 columns wide for the 500 points of data. So that massive data sheet is updated on a weekly basis, and then they use that raw data to populate the PDF that comes out every 13 weeks. But also within their website, they have alerts. So if they told you something they expected was going to happen 13 weeks from now, but something has changed, they'll have a little alert beside the company as well. So sometimes if you want to show them there what a value line looks like. So if you want to look at that AEIS value line,
Yeah.
just show them that.
Just talk amongst yourself.
Yeah, so whenever you look at a value line report, folks, there's a lot on that dashboard when you even go in, before you even download the PDF. So I'm looking at Advanced Energy here, and already they've got 2 alerts. So they're constantly monitoring everything on a weekly basis in terms of fundamentals. And then they're also monitoring the options on an hourly basis. They're actual, when you get deep into the way they forecast option movement and the likelihood of a share option ending up above or below a strike price, that number crunching is done 7 times a day. They update their option number crunching every hour as well. So is that there now, Jeff, to show people?
Yeah.
So if you click on the tab to the left of that tab, see where it says the value line research, the tab at the very, very top?
Oh, no, it's hidden by...
So see where it says no job name, and then to the left of no job name?
No, I can't see it because the Zoom dashboard's in the way of it.
All right, the Zoom dashboard's in the way. Okay.
There we go. I can sort of reduce it for a bit. And
yeah, you can get in behind it there, yeah. There you go. So if you scroll back up to the top there, up to the very, very top, so you can see there, there's alerts. See the 2 alerts? So you can click on those 2 alerts. Just underneath the 3 to 5 year target, it says alerts.
oh yeah, I'm with it.
Yeah. So if there anything changes in the week, they'll update you. That's where you get your instead of having to wait 13 weeks for some news, they'll update that every week. So if there's any new things that have cropped up during the week, they'll put it in there as well for you.
Yeah. So as well as the PDF, there's all this data as well that we're constantly updating and looking at.
Yeah, you got to remember, folks, they've been doing this for 91 years. There's no other company in the world has got such a data bank of knowledge and that they can use to forecast. So in 1965, after 34 years, from 1931 to 1965, they're 34 years collecting data. They then established the timeless rank and the safety rank, which are 2 very powerful performance indicators as well. So these were developed in 1965. So the timeless and safety are now back tested to 1965, which is what, almost 58 years now of they can prove how well companies with a timeless of 1 do, how timeless of 2 does. So they've all that data as well. So you can go down the rabbit hole. There's loads of stuff in here.
But you can see there's lots of figures, how much debt they've got, but also good commentary, and we even know the name of the person actually does it, and we follow them along. They're looking at it all the time.
Yeah, sometimes we've seen the same guy follow a company for 20 years, so they're very well experienced. And if the earnings growth is double digit, that's a very strong profit drives price. So if you see double digit earnings forecast, then that's going to be a lot of energy that's going to drive your share price up long term.
But you're right. I mean, news also drives price, but news tends to drive it in the short term, and price and profit drives it in the longer term.
Yes, 100%. Yeah.
Any more for any more?
No, thank you both.
That's fine.
Okay. Right, I'm going to get a cup of tea. Thank you very much.
Thanks.
All right, have a
Thank you
lovely
very
evening,
much,
folks.
everybody.
Thank you.
Bye, everyone. Bye-bye.
Cheers.
Cheers, bye.